Welcome to simplefinancesupport.com. Today I would like to provide financial accounting concept and terms fact series accounting equation discussion. This provides fundamental and basic building blocks of accounting for non-accounting professionals. There has been a request from different consultants, particularly those who are from non-accounting background, who are working as finance professionals in SAP and Oracle area, to provide them very clear understanding of the accounting equation, meaning how the debit and credit functionality works. I would like to give a simplistic view of financial accounting equation. Basic equation is always assets equals to liabilities plus equity. So when we say assets equal to liabilities plus equity, what we are trying to explain here is that in any organization which is called as a legal entity or an entity, basically you can call as an entity, you will always have assets. Equivalent of that assets, there will be liabilities. So when we say liabilities, the total liabilities, which constitutes of owner's liability and outsider's liabilities. Owner's liability is equity, meaning the entity has to give this equity back to the owner, which means from the entity perspective, the equity, which is capital, is also a liability. So that is the reason you represent capital as a liability at the liability side of your balance sheet. So total liabilities always equals to total assets, and this forms the fundamental concept of balance sheet. So whenever you look at the balance sheet, you have debit asset side and a liability side. So asset sides represent all the assets, maybe short-term assets, long-term assets, sometimes we call fixed assets, working capital assets. So assets may be whatever, but the total assets would be equal to the liability side of the balance sheet, which is total liabilities. Within that you have equity as well as the liabilities. So this is the fundamental accounting equation. So let us see how it is framed behind the scenes. So when we say an entity operating business, so you have business transactions. So any transaction which is resulting in money or financial nature need to be recorded, right? That is the fundamental requirement of your accounting. So all these as transactions can be segregated into four types: assets, liabilities, expenses, and revenues. Expenses and revenues are for the purpose of operating the business. When you say that operating the business, the basic purpose of any entity, whether it is a commercial entity or non-commercial entity, whether it is a small entity or big entity, whether it is a sole proprietorship or a conglomerate, they need to operate. In order to operate the business, they have to sell something or do some service, and for doing that they need to pay some expenses. So that's what expenses and revenues are, the fundamental blocks of your profit and loss statement. The profit and loss statement results in obviously retained earnings, which means like normally you're expecting that revenues are more than your expenses. Some circumstances, if the company is making losses, so then your expenses would be more than your revenues, obviously. But let's assume that revenues are more than expenses, you will have some retained earnings. So plus equity. So obviously, plus or minus, if I say that retained earnings, if it's a minus means loss. So the resultant of your profit and loss statement belongs to your owners. So that is the reason either you are adding to the capital or reducing the capital, which is equity. So equals to your ending equity, right? So during a period you operate, you sell, and your expenses are incurred. So then end of that particular period, then you are trying to make out like how much is your earning during that period, and then you're trying to frame your balance sheet. So that is the reason that equity is constantly changing because of the retained earnings for every period. So that equity again plus liabilities equals to assets. So the equity is resultant of your profit and loss statement, which is expenses and revenues, and obviously assets will go into the assets, liabilities will go into the liabilities. So with this, any business transaction that you do is resulting in your assets equals to liability concept, right? Which is like nothing but your financial position at any given point of time, which is nothing but your balance sheet. Okay, let's look at overall the impact. So for all business transactions, you are having double entry system, meaning any business transaction that you do has got debit and credit, same way debit and credit for every transaction that you do, whether you are procuring an asset or whether you are paying salaries or the owner is investing. So whatever you do, you have the impact of debit and credit. So that is the reason your assets are equals to liabilities, total liabilities. By nature of this double entry system, they are automatically balanced. So that is the reason your balance sheet is always balanced. Liabilities are equal to assets. Again, here the concept is double entry system, right? So like now every transaction has got double entry system having debits and credits. Okay, so let us look at closely what is happening here. So assets, liabilities, expenses, revenues. So now we are going into the accounting terminology. Assets are treated as real accounts, liabilities are called as a personal accounts, then expenses and revenues are called nominal accounts. Okay, so fundamental accounting entry that we talked about double entry system, which is debit and credit, is framed around these three types of accounts: real accounts, personal accounts, and nominal accounts. Real accounts are assets, personal accounts are liabilities, and expenses and revenues are nominal accounts. Okay, so again the business transactions always have to be segregated into either of these, and one particular transaction can be resulting in only real asset accounts or real and personal accounts, real and nominal accounts, personal and nominal accounts, like that. So the combination of impact of a business transaction can be on anything, but it will definitely have a two impacts, which is debit and credit impacts. So let's look at the accounting entry for assets that we talked about, real accounts. So the real accounts may be real physical assets, or they may be fictitious assets. Okay, so by default all the real accounts have debit balance. You expect that when there is an asset, means there is a like a value which is there. That is the reason by default it's the debit balance. So what comes in is treated as a debit. Again, that is what it is resulting adding balances to your asset, right? So that increases. Sometimes you are selling, maybe, right? So that is the reason what goes out as a credit, so which is reduction of your asset value. So the total ending balance is normally debit, which is a resultant of whatever was there, and then additions and subtractions. So normally asset value will not go into minus, negative. I mean, there may be some situations, but again, we are not talking about very detailed situations, but we are in a simplified manner. Asset means having a debit balance, and what comes into the company, which is debit, and what goes out from the company, from the entity, which is treated as a credit. Let's look at the accounting entry concept for liabilities. So liabilities, as we talked about, natural or legal. So when it's natural, basically the liabilities now we personal accounts, we say. So by default liabilities are credit balance, meaning entity has to give something back to the person who either given a loan or given a capital, right? So that's what by default you are having a credit balance. Okay, so again, credit the giver, debit the receiver. So for example, if bank is giving a loan to the entity, so the cash is coming in, obviously as a real account it's a debit, and who is giving here? The bank, which is like a legal entity, which is person, which is what the credit giver, and then debit receiver. Okay, so the receiver, debit means, for example, you are depositing some amount in maybe bank, so other way around. So here in this case, who is receiving? The bank is receiving, so obviously you are debiting that, and then what is going out as a cash, it's going out. So debit the receiver, and and credit the giver. Again, by default, liabilities account is a credit balance, and then ending balance is a credit balance. So obviously it is expected that when you say liability side, which is a kind of a credit balance. Again, this rule may not be applicable in every kind of accounting situation, but it is a very simplified manner that you can think of. Okay, so now let's look at real accounts accounting entry, which is like by default expenses or debit, and by default revenues are credit. Okay, so these are the nominal accounts, expenses and revenues, right? So let's look at all expenses are debit. That's what is happening. All expenses are debit, all revenues are credit. So obviously all revenues are credit here. So does it mean that you will never have a credit in your expenses? You will have sometimes credits and sometimes debits for your revenues also, but this is a majority of the situation, all expenses that you incur. What are the kind of, there are many kinds of expenses like salaries, wages, postal expenses, telephone expenses, marketing expenses. All these are the expenses, all they go as a debit side of your P&L obviously, and then the credit side goes your revenues and this interest that you earn. Certain situations, like for example interest, either it can be an expense or revenue depending upon what exactly is happening. For example, if you are earning interest, that is a revenue. If you are paying interest on your loans, that would be your obviously a kind of expense, right? So it all depends on exactly how so total expenses, total revenues obviously result in your profit or loss. So that is what we talked about as a retained earnings. If you are retaining back, and either profit or loss, if the loss is there, owner's equity will be reduced, and profit is there, owner's equity will be increased, because the purpose of this entire entity is to see that record everything, okay, and then whatever the resultant of your operations from sales and your expenses, then that you add it up to the retained earnings positively or negatively. Okay, so this is the real accounts accounting entry. So carefully, if you observe, three situations we talked about: real accounts, personal accounts and nominal accounts. Okay, so the overall situation, if you see, every time that you do any transaction, business, for example investment by owner, so cash is coming in, it's a real account, and owner's capital, which is a kind of a personal, which is a obviously owner is a giver. Okay, and so it's not the receiver, right? Giver, you're crediting that guy, and then cash account. So the purchase of assets, obviously assets are coming debit and cash is going out as a credit. So in this case, purchase of asset is all real accounts, right? Cash as well as asset. Purchase of asset from vendor, obviously payables with the vendor is a personal, and then the cash is a real account. Loan from bank, again bank is a vendor kind of thing, in this case a person, and then the cash is again a real asset. Payment of salaries, in this case you have a real which is obviously cash account that is going out, and then expense, which is all expenses are obviously nominal and debits, right? And sale of goods to customer, a receivable account, obviously the personal, the customer is a person, right? So receivable accounts, and then the nominal revenue, nominal account. So like that, if you carefully observe the debit and credit, consistently either real account or personal account or real and personal account, like that the combination of different accounts will be there. So depending upon what type of business transaction that you're working on. Hopefully I made it clear about the concept of accounting equation. Please visit us at www.simplefinancesupport.com, and we are providing the fact series, which is financial accounting terms and concepts. The greater length of discussion will be there for different concepts. Thanks for watching.